What happens when money itself grows scarce? When trust between banks evaporates like morning fog, and credit, that invisible fuel of commerce, begins to drain away. Can an economy collapse not from lack of goods or willing hands, but simply because the medium of exchange retreats into shadows? Tonight we drift back to the 1930s, to a time when the machinery of finance seized up in slow motion. Take a slow breath. The Great Depression wasn't a single earthquake. It was a long, grinding pressure, a slow storm born from tight money and shattered confidence. If you'd like more calm market history, you can subscribe. This is history, not financial advice. The year 1929 opened with optimism. Stock prices had climbed for years, lifted by industrial expansion, electrification, automobile production spreading across the nation. Banks extended credit freely. Brokers offered margin loans, allowing speculators to buy shares with borrowed funds. The Federal Reserve, still young, watched the speculation with growing unease. In August of that year, the Fed raised its discount rate to roughly 6%, the rate at which it lent to member banks. The intent was clear: cool the market, restrain excessive borrowing. But markets have their own momentum. Through September, stock prices wavered. Then came October. On the 24th, panic selling began. By the 29th, Black Tuesday, the New York Stock Exchange recorded losses that wiped out billions in paper wealth. Margin calls cascaded. Investors who had borrowed to buy stocks now faced demands for immediate repayment. Many couldn't comply. Brokers sold shares into a falling market, accelerating the decline. In the aftermath, something quieter began. Banks had lent heavily, not just to speculators but to businesses, farmers, homeowners. As asset values fell, the collateral backing those loans shrank. A bank's balance sheet depends on confidence. Depositors must believe their money is safe. Borrowers must believe they can repay. When doubt creeps in, the system weakens. By early 1930, banks across the country began to fail. Not the large money center institutions in New York, not yet, but smaller banks in agricultural regions, in towns where crop prices had fallen and farmers defaulted on loans. Each failure sent ripples outward. Depositors at neighboring banks grew nervous, withdrew funds. The withdrawn currency didn't flow back into the system. People hoarded cash, kept it under mattresses, buried it in backyards. Money stopped circulating. The Federal Reserve faced a choice. It could expand the money supply, inject liquidity, lower interest rates to encourage lending, or it could maintain discipline, protect the gold standard, preserve the dollar's convertibility. The Fed chose the latter. Gold reserves mattered. International credibility mattered. The central bank held firm. Meanwhile, the real economy slowed. Factories reduced production. Workers lost jobs. Unemployment climbed from around 3% in 1929 to nearly 9% by the end of 1930. With less income, consumers bought less. Businesses saw revenues fall, cut costs further, laid off more workers. The cycle fed itself. In the background, another mechanism operated, one less visible but equally powerful. The money multiplier effect, the way banks create credit by lending out deposits, began to reverse. Normally, when someone deposits $100, the bank lends most of it, keeping only a fraction as reserves. The borrower spends that money, which gets deposited elsewhere, lent again, creating multiple layers of purchasing power from a single initial deposit. But when banks fail or hoard reserves, the process inverts. Each dollar withdrawn from circulation removes several dollars of potential credit. The money supply contracts. By 1931, the contraction accelerated. European banks, weakened by war debts and their own speculative excesses, faced crises. In May, Austria's Kreditanstalt collapsed, among the largest bank failures Europe had seen. The shock spread. Britain abandoned the gold standard in September, allowing the pound to float. Investors feared the United States might follow. Gold flowed out of American banks, out of the country, seeking safer havens. The Federal Reserve responded by raising interest rates again. In October 1931, the discount rate moved from around 1.5% to roughly 3.5% within weeks. The logic was orthodox: defend the gold standard, prevent capital flight, maintain international confidence. But the effect was contractionary. Borrowing became more expensive precisely when businesses and consumers needed credit most. Banks, already cautious, pulled back further. What does tight money feel like on the ground? Imagine a farmer in Iowa. Wheat prices fallen by half, unable to repay his bank loan. The bank forecloses, takes the land, but can't sell it because no one has cash to buy. The farmer moves to the city, searches for work, finds none. Factories are closing, construction has stopped. The city, once bustling, grows quiet, shops shutter, bread lines form. By 1932, industrial production had fallen to roughly half its 1929 level. Unemployment reached around 24%. 1 in 4 workers without a job. Banks continued to fail, over 2,000 in 1931 alone. Each failure destroyed deposits, erased savings, left communities without access to credit. The financial system, which should allocate resources, facilitate exchange, enable growth, instead transmitted fear and paralysis. In March 1933, the banking system nearly stopped altogether. Panic withdrawals spread state by state. Governors declared bank holidays, temporary closures to prevent runs. When Franklin Roosevelt took office on March 4th, he declared a national bank holiday within 2 days. Every bank in the country closed. For several days, the United States operated without a functioning banking system. The Emergency Banking Act followed quickly. The government would inspect banks, support solvent ones, close insolvent ones. Over the following months, Congress passed the Banking Act, which among other provisions would establish the Federal Deposit Insurance Corporation. By early 1934, deposit insurance began protecting savings, a fundamental shift in how Americans related to their banks. Slowly, banks reopened. Roosevelt's fireside chats, broadcast on radio, urged calm. In his first inaugural address, he had spoken about fear itself being a central obstacle, suggesting that psychological paralysis compounded material problems. People began to redeposit currency. The acute panic eased, but the damage had accumulated over 3.5 years. The money supply had contracted by roughly a third. Prices had fallen, wages had fallen, debt burdens had grown heavier in real terms. Deflation punishes debtors, rewards creditors, discourages spending. Why buy today if prices will be lower tomorrow? Why invest if returns must be paid back in more valuable dollars? The deflationary spiral created its own logic, self-reinforcing and difficult to escape. Each price decline made existing debts more burdensome. Each default made lenders more cautious. Each new restriction on credit made recovery harder. The economy trapped itself in a low-activity equilibrium where rational individual decisions, hoarding cash or refusing to lend, collectively produced disaster. The Federal Reserve's role in this slow storm has been debated ever since. Scholars examining American monetary history argued that the Fed failed in its fundamental duty. A central bank exists, they reasoned, to prevent exactly this kind of collapse, to supply liquidity during crises, to act as lender of last resort. Instead, the Fed allowed the money supply to contract, permitted bank failures to cascade, raised interest rates when it might have lowered them. Others defended the Fed's choices. The gold standard imposed constraints. If the central bank printed money without limit, gold would flee, the dollar would lose value, international confidence would shatter. The Fed operated within a system bound by rules it didn't create. To blame the Fed alone, these voices said, ignores the broader architecture. Both perspectives hold truth. Systems create incentives, shape choices, but within those systems, institutions decide, act, refrain from acting. The Fed had tools: open market operations, buying government securities to inject reserves into banks; discount window lending, providing emergency liquidity to solvent institutions facing temporary shortages; moral suasion, guiding expectations, signaling support. The Fed used these tools sparingly, reluctantly. Why? Partly ideology. Many policymakers believed depressions purged excesses, that markets should correct themselves, that intervention would delay necessary adjustments. Partly fear. Fear of inflation, fear of speculation resuming, fear of losing gold, fear of appearing weak. Fear in a crisis often leads to tightness when looseness is needed. Consider Benjamin Strong, governor of the Federal Reserve Bank of New York through the 1920s. Strong understood central banking subtleties, maintained relationships with European counterparts, orchestrated coordination. When he died in 1928, the Fed lost its most skilled leader just before the crisis. His successors were competent but cautious, less willing to experiment, less confident in their judgment. In Washington, the Federal Reserve Board, distinct from the New York Fed, held different views. Tensions between New York and Washington complicated policy. New York wanted activism, intervention. Washington preferred restraint, adherence to principle. The structure of the Federal Reserve System itself, with regional banks and a central board, created ambiguity about authority, slowed decision-making. Meanwhile, across the Atlantic, the Bank of England faced its own struggles. Montague Norman, the bank's governor, had worked closely with Strong to stabilize currencies after World War I. Britain had returned to the gold standard in 1925 at the pre-war parity, overvaluing the pound, making British exports expensive. The economy stagnated. Unemployment persisted. When crisis came in 1931, Britain couldn't hold. Norman, exhausted, suffered a breakdown. The pound floated. The gold standard, once a symbol of stability, had become a straitjacket. Countries adhering to it imported deflation from one another. If one nation's prices fell, its exports became cheaper, putting pressure on competitors to lower their prices too. The system transmitted contraction globally. Only by breaking free could nations regain monetary flexibility. France, ironically, benefited initially. French authorities had undervalued the franc in the mid-1920s, accumulating gold reserves as the currency stayed competitive. By the early 1930s, France held enormous gold stocks, but used them defensively, hoarding rather than lending. The gold sat idle in vaults while the world starved for liquidity. Back in the United States, deflation changed the landscape. A dollar in 1933 bought significantly more than in 1929. For those with cash, with secure jobs, life improved materially. But most people had less cash, less security. Farmers faced falling crop prices while their mortgage debts remained fixed. Urban workers saw wages cut or lost employment entirely. The deflation that helped savers crushed debtors. Debt deflation, a concept articulated by economist Irving Fisher, describes this trap. When prices fall, the real burden of debt rises. Borrowers must repay loans in dollars that are more valuable than the dollars they borrowed. Defaults increase. Lenders, anticipating defaults, tighten credit further. The contraction deepens. Fisher himself experienced this personally. He had invested heavily in the stock market, lost his fortune in the crash, spent years repaying debts. His theory emerged partly from his own pain, a scholar trying to understand the forces that had destroyed him and millions of others. In the heartland, the Dust Bowl compounded the Depression's misery. Overfarming had stripped topsoil. When drought came in the early 1930s, winds lifted the earth itself, darkening skies, burying farms. Families packed belongings onto trucks headed west toward California, hoping for work. Writers and photographers documented their plight, creating images that became icons of the era's suffering. But the Dust Bowl wasn't separate from financial collapse. It was entangled. Farmers needed credit to survive bad years, to buy seed, to hold land. Without functioning banks, without lending, they had no cushion. Environmental disaster and monetary contraction merged into a single catastrophe. In cities, shanty towns sprang up on vacant lots, clusters of makeshift shelters built from scrap wood and metal. People called them Hoovervilles after President Herbert Hoover, blaming him for inaction. Hoover, an engineer by training, believed in voluntary cooperation and letting private charities handle relief. He resisted direct government aid, feared creating dependency. His philosophy, rooted in individualism, seemed inadequate against the scale of collapse. Roosevelt's election in 1932 brought a different approach. The New Deal, a flurry of programs and agencies, attempted to restart the economy through government spending, public works, financial regulation. The Securities Act of 1933 aimed to restore trust in markets by requiring disclosure, punishing fraud. The Glass-Steagall Act separated commercial banking from investment banking, trying to prevent the conflicts of interest and speculation that had contributed to the crash. The National Industrial Recovery Act encouraged businesses to coordinate production, set minimum wages, reduce competition. The logic was that cutthroat competition had driven prices down, forced layoffs, created a race to the bottom. Cooperation, supervised by the state, might stabilize prices, preserve jobs. The Supreme Court later struck down the act, but for a time it shaped industry behavior. The philosophy behind these interventions represented a fundamental shift. Before the Depression, the federal government played a limited role in economic management. Markets were expected to self-correct. Downturns, while painful, were seen as natural adjustments. The New Deal challenged this assumption, arguing that government had both the capacity and the responsibility to stabilize the economy, to provide relief, to prevent collapse. Whether this shift was wise remains debated. Critics argue it expanded government beyond its proper bounds, created dependencies, distorted markets. Supporters argue it saved capitalism from itself, preserved democracy, built infrastructure that served generations. Both views reflect genuine values, genuine concerns about the proper role of the state in economic life. Agricultural policy shifted too. The Agricultural Adjustment Act paid farmers to reduce production, hoping to raise crop prices by limiting supply. Critics called it wasteful, absurd to destroy food while people went hungry. Defenders argued it restored balance, allowed farmers to earn enough to stay solvent, to maintain their land. The logic behind agricultural intervention was straightforward but controversial. Overproduction had driven prices below the cost of production. Individual farmers, acting rationally, kept planting, hoping to make up in volume what they lost in price. Collectively, this made the problem worse. The AAA attempted to solve this coordination failure by paying farmers to plant less, raising prices through scarcity. Public works projects multiplied. The Civilian Conservation Corps employed young men to plant trees, build trails, combat erosion. The Works Progress Administration constructed schools, bridges, post offices, hired artists to paint murals, writers to document local histories. The Tennessee Valley Authority dammed rivers, brought electricity to rural areas, demonstrated the state's capacity to reshape landscapes. These programs didn't end the Depression immediately. Unemployment remained elevated through much of the 1930s, but the programs changed expectations, signaled that government wouldn't simply watch as the economy collapsed. Confidence, that intangible foundation of finance, began to rebuild. Monetary policy eventually loosened. After abandoning gold convertibility for domestic purposes in 1933, the Roosevelt administration devalued the dollar in 1934, raising the official gold price from around $20 per ounce to $35. The move increased the nominal value of gold reserves, allowed the Fed to expand the money supply without violating gold coverage requirements. Slowly, deflation reversed. Prices began to rise gently, but habits formed during the contraction lingered. Banks, burned by failures, held excess reserves, lent cautiously. Businesses, uncertain about demand, hesitated to expand. Consumers, remembering hardship, saved more, spent less. The velocity of money, the rate at which currency changes hands, remained low. Even as the money supply grew, its impact on activity stayed muted. In 1937, the economy stumbled again. The Federal Reserve, seeing reserves accumulate, worried about future inflation, raised reserve requirements. The Treasury, balancing the budget, cut spending, simultaneously tightening fiscal and monetary policy. The government induced another sharp contraction. Industrial production fell. Unemployment spiked back up. The mistake revealed how fragile the recovery had been, how sensitive the economy remained to policy errors. The 1937 recession within the Depression taught its own lesson. Recovery wasn't automatic. Simply removing the most acute pressures didn't guarantee return to full employment. Active support, sustained over time, seemed necessary. Withdrawing that support prematurely could trigger renewed collapse. What lessons did the experience teach? Economists drew different conclusions. Some emphasized the role of government spending, fiscal stimulus, the need for active demand management. Others focused on the money supply, the Fed's failures, the importance of preventing monetary contraction. Still others argued the boom of the 1920s had been unsustainable, that the bust was inevitable, that intervention prolonged adjustment. Policymakers absorbed their own lessons. The Fed gained independence but also accountability. The Employment Act of 1946 made full employment a national goal. Automatic stabilizers, unemployment insurance, progressive taxation helped cushion future downturns. Deposit insurance prevented bank runs. Regulations constrained speculation. The architecture of the post-war economy reflected fear of repeating the 1930s. For a generation, the memory of the Depression shaped behavior. People who lived through it saved more, borrowed less, distrusted speculation. They told their children stories of hardship, instilled caution. Banks rebuilt slowly, remained conservative. Finance, so central to the 1920s, receded. The era from the late 1940s through the 1960s saw finance as a quiet utility, regulated, predictable, dull. But memory fades, institutions evolve. The children who heard Depression stories didn't experience the fear themselves. By the 1970s, inflation had replaced deflation as the dominant concern. By the 1980s, deregulation began dismantling the constraints erected in the 1930s. Glass-Steagall eroded, then repealed in 1999. Financial innovation accelerated. Leverage returned. Understanding the Depression requires seeing it not as a single event, but as a process, a slow-moving storm that built over months and years. The stock market crash of 1929 was dramatic, visible, but it wasn't the Depression itself. Many economies had weathered market crashes before without collapsing. What made the 1930s different was the monetary contraction, the wave of bank failures, the policy paralysis, the international transmission of deflation through fixed exchange rates. Money is strange. It has no intrinsic value, just paper and ink, or increasingly, digital entries in ledgers. Its worth derives entirely from trust, from the belief that others will accept it, that it will hold purchasing power, that the system behind it will endure. When trust breaks, money ceases to function properly. It hides, it hoards, it stops circulating. The economy, deprived of its lifeblood, withers. The gold standard embodied a particular kind of trust in a fixed relationship between currency and metal. Gold itself has limited practical uses, but its scarcity, Durability and historical role as a store of value made it anchor monetary systems for centuries. Under the gold standard, governments promised to exchange currency for gold at a set rate. This constrained how much money they could create, limited inflation, enforced discipline. But the discipline was rigid. When economic conditions changed, when shocks hit, the gold standard prevented flexible response. A country losing gold had to contract its money supply, raise interest rates, accept deflation and unemployment. The alternative, abandoning the standard, meant breaking a promise, risking credibility. The choice was painful either way. Britain's departure in 1931 showed that abandoning gold didn't bring catastrophe. The pound fell, making British exports cheaper, helping the economy stabilize. Other countries took note. Over the next few years, nation after nation left the gold standard. By the mid-1930s, gold's role had diminished. Bretton Woods, the post-war monetary system established in 1944, created a modified gold standard with the dollar convertible to gold but other currencies fixed to the dollar. Even that system collapsed in 1971. Today, all major currencies float, their values determined by markets and central bank policies rather than metal. The transition away from gold was gradual, contested, traumatic. It required rethinking what money was, what backed it, what gave it value. The answer, ultimately, was the productive capacity of the economy, the willingness of people to accept it in exchange, the credibility of institutions managing it. These are abstract foundations, harder to grasp than metal in a vault, but more adaptable, more suited to a complex, dynamic economy. In the 1930s, that transition was incomplete. Policymakers still thought in gold standard terms, still prioritized convertibility, still feared the consequences of monetary expansion. Their caution, their adherence to old rules in new circumstances, prolonged suffering. One quiet tragedy of the Depression was wasted potential. Factories stood idle, capable of producing but lacking customers. Workers wanted jobs, possessed skills, but couldn't find employment. Resources existed, needs existed, but the financial system failed to connect them. The contraction wasn't physical, wasn't real in the sense of bombed cities or exhausted mines. It was a failure of coordination, of trust, of the invisible mechanisms that allow complex economies to function. Imagine a farmer with surplus wheat, a baker needing flour, a city worker wanting bread. Under normal conditions, money links them. The worker earns wages, buys bread, the baker buys flour, the farmer receives payment, uses it to buy tools or clothing, and the cycle continues. But if the worker loses his job, if banks won't lend to the baker, if the farmer can't sell wheat at a viable price, the chain breaks. Goods rot. People go hungry. Not because food doesn't exist, but because the system for exchanging it has broken down. This is the paradox of economic depression. Material wealth remains, skills remain, but the organizing mechanism fails. Money, that tool for facilitating exchange, instead becomes an obstacle, hoarded and scarce. The solution seems simple: create more money, restore the flow. But creating money requires trust, requires institutions willing to act, requires overcoming fear and ideology. The Federal Reserve, established in 1913, was still learning its role. Its founding came in response to the panic of 1907, when the financial system had nearly collapsed, saved largely by private coordination. The idea was to create a permanent lender of last resort, an institution that could supply liquidity during crises. But the Fed's structure, with regional banks and a central board, diffused authority. Its mandate, balancing multiple goals, created ambiguity. Its experience was limited. The Depression became the Fed's trial by fire, and by most accounts, it struggled. The lessons, learned painfully, reshaped central banking. After World War II, the Fed gained clearer mandates, better tools, more experience. It made mistakes over the decades, tightening too much at times, easing too little at others. But over time, Central banks globally became more skilled, more willing to act decisively during crises. Yet, even with better crisis management tools, vulnerabilities remain. Financial systems are inherently fragile. They depend on confidence, on the belief that counterparties will honor obligations, that assets can be liquidated, that liquidity will be available. When doubt spreads, the system can seize up quickly. Modern finance is more complex than in the 1930s. Derivatives, securitization, high-frequency trading, shadow banking, global capital flows all add layers. The interconnections mean shocks transmit faster, across borders, across asset classes. A problem in one market can threaten institutions elsewhere, affect pension funds across oceans, destabilize emerging economies. Complexity breeds new forms of contagion. Regulation attempts to contain these risks. Capital requirements force banks to hold buffers. Stress tests assess resilience. Resolution authority allows orderly winding down of failing institutions. Macroprudential tools, adjusting lending standards or reserve requirements, try to prevent bubbles. But regulation always lags innovation. Financiers seek profit, find ways around constraints, create new products, new structures. Regulators respond, then innovators adapt again. The cycle repeats. The Depression also revealed how economic hardship strains social fabric. Unemployment and poverty create desperation. When established institutions appear helpless, people seek alternatives. In several countries during the 1930s, severe economic distress preceded significant political changes, though the specific paths varied widely depending on existing institutions, cultural contexts, and leadership choices. In America, despite hardship, democracy survived. Elections continued. Debate continued. The New Deal faced opposition, criticism from left and right. Some called it socialism. Others said it didn't go far enough. But the system absorbed the conflict, adjusted, evolved. The Constitution endured. Power transferred peacefully. This resilience wasn't guaranteed. In 1932, veterans marched on Washington demanding early payment of bonuses promised for World War I service. The bonus army camped in the Capitol, protested, refused to leave. Hoover ordered the army to clear them. Troops used tear gas, burned the veterans' camps. The spectacle shocked the nation, crystallized frustration with the administration. Roosevelt's inauguration months later promised change. His rhetoric, optimistic yet realistic, reassured. His early initiatives, whether economically optimal or not, demonstrated action. People needed to believe the government understood, cared, had a plan. Whether the plan worked perfectly was almost secondary. The appearance of decisiveness helped restore a measure of confidence. Some historians argue the New Deal's direct economic impact was modest, that recovery came mainly from monetary expansion and eventually from war production. Others credit the programs with preventing social collapse, maintaining stability, building infrastructure that served the nation for decades. Both views hold elements of truth. Economics and politics, material conditions and perception intertwine. Separating them cleanly is difficult. What's clear is the Depression reshaped America. It expanded government's role, created the modern welfare state, established expectations that the state would manage the economy, provide safety nets, intervene during crises. Before the 1930s, such ideas were marginal in American politics. After, they became mainstream, at least for several decades. Globally, the Depression weakened liberal internationalism. Countries turned inward, raised tariffs, formed currency blocs, pursued autarky. The Smoot-Hawley tariff, passed by the United States in 1930, raised duties on thousands of imports. Trading partners retaliated. Global trade collapsed, falling by roughly two-thirds between 1929 and 1933. The contraction amplified the Depression, spread it worldwide. Economic nationalism contributed to rising geopolitical tensions. Countries competed for resources and markets. Cooperation became harder. The international order, already fragile after World War I, fractured further. The League of Nations proved ineffective at mediating disputes. These economic stresses created conditions that, combined with many other factors, contributed to the deterioration of international relations through the late 1930s. The connection between economic crisis and political instability is real, but not deterministic. Severe hardship creates pressures, but outcomes depend on institutions, leadership, culture, choices. Different societies responded to similar economic shocks in vastly different ways. Some preserved democracy, others didn't. The variation reveals that economics alone doesn't determine political outcomes. The Bretton Woods system, created after World War II, aimed partly to prevent repeating the 1930s economic mistakes. The International Monetary Fund and World Bank promoted exchange rate stability and development. The General Agreement on Tariffs and Trade reduced barriers to trade. The Marshall Plan rebuilt Europe, integrated economies, reduced zero-sum competition. These institutions reflected lessons learned. Open economies, stable currencies, international cooperation might prevent future depressions and the tensions they could generate. For several decades, the system worked reasonably well. The post-war period saw growth, rising living standards, relative stability. The Depression faded into history, a cautionary tale studied but not viscerally feared. But as time passed, memory faded. New generations, who hadn't experienced the Depression, questioned the constraints. Why regulate finance so heavily? Why limit speculation? Why maintain capital controls? The answers, rooted in 1930s trauma, seemed less compelling by the 1980s. Deregulation began gradually. Interest rate ceilings lifted. Geographic restrictions on banking eased. Securities firms gained new powers. Glass-Steagall's separation of commercial and investment banking eroded through exemptions and reinterpretations. Derivatives markets exploded, largely unregulated. Leverage ratios increased. Financial institutions grew larger, more complex, more interconnected. The changes brought benefits. Financial innovation increased efficiency, lowered costs, expanded access. Consumers gained more mortgage options, more credit cards, more investment choices. Businesses could hedge risks, raise capital more easily. Capital flowed across borders, funding development, equalizing returns. But the changes also brought risks. Complexity obscured dangers. Leverage amplified gains and losses. Interconnections meant contagion could spread instantly. Old safeguards, designed for simpler systems, didn't fit new realities. Shadow banking, entities performing bank-like functions without bank-like regulation, grew enormous. When housing markets peaked in the mid-2000s and began falling, the effects cascaded through complex securities backed by mortgages. Banks and investment firms held these securities, often financed with short-term borrowing. As values fell, lenders demanded more collateral. Firms scrambled to sell assets into falling markets. Liquidity evaporated. In September 2008, Lehman Brothers filed for bankruptcy, the largest such failure in American history. The parallels to the early 1930s were unmistakable. Panic spread through global markets. Interbank lending, the flow of short-term credit between financial institutions, froze. Money market funds, considered safe, faced withdrawals. Commercial paper markets seized. The machinery of finance stopped working, but the response differed dramatically from the 1930s. Central banks and governments, having studied that earlier crisis, acted decisively. Interest rates dropped toward zero. Central banks expanded their balance sheets, buying securities to inject liquidity. Governments recapitalized banks, guaranteed debts, stimulated demand through spending. The tools were unconventional, the scale unprecedented in peacetime, but the goal was clear: restore confidence, prevent cascade, avoid depression. The approach succeeded in preventing complete collapse. Banks stabilized. Markets recovered. Though recovery took time, unemployment rose sharply, peaking around 10% in the United States, but didn't reach 1930s levels. The financial system, though damaged, continued to function. Yet the aftermath brought its own challenges. Recovery was slow, uneven. Housing prices fell sharply, destroying household wealth. Growth returned but remained subdued for years. Labor markets took nearly a decade to fully heal. Inequality widened as asset prices recovered faster than wages. Public anger grew. The crisis revealed that preventing depression, while crucial, doesn't guarantee rapid return to prosperity. The tools that stabilize finance in acute panic work differently during long recovery. Interest rates pinned near zero lose effectiveness. Fiscal policy faces political constraints. Structural problems in the economy, hidden during the boom, become visible and persistent. Populist movements gained strength in the aftermath across the political spectrum. Trust in financial institutions, already fragile, deteriorated further. Questions about capitalism, about finance, about fairness, moved from margins to center. The political landscape shifted in ways still unfolding. Each crisis teaches. Each response draws on past lessons, creates new precedents. The toolkit expands. But fundamental tensions remain. How much intervention is too much? When does preventing crisis create moral hazard, encouraging future excess? How do we balance stability and dynamism, security and freedom, collective action and individual responsibility? These questions have no final answers. They're contested in every generation, shaped by circumstances, ideology, power. The 1930s reflected particular answers, particular choices. The Depression could have been shorter, less severe, if different policies had been chosen. But understanding that requires hindsight, requires knowledge. Policymakers at the time lacked. In real time, facing uncertainty, weighing competing risks, making decisions with incomplete information, leaders did what seemed prudent. They feared inflation, feared speculation, feared abandoning gold, feared government overreach. Their fears, in retrospect, were misplaced. Deflation, not inflation, became the threat. Inaction, not overreach, prolonged pain. But they couldn't know this with certainty. Empathy for historical actors requires imagining their constraints, their uncertainty, their worldview. It's easy to judge from the future, knowing outcomes, seeing mistakes. It's harder to recognize how choices that seem obvious now appeared risky or foolish then. The gold standard, for instance, seems irrational today. Why tie money to metal? Why import deflation to preserve convertibility? But for people in the 1930s, gold represented stability, trust, international order. Abandoning it felt like abandoning principles, like admitting defeat. Britain's departure in 1931 shocked contemporaries. The pound had been tied to gold for generations. Breaking that link seemed potentially catastrophic, even though it helped the British economy recover. Similarly, balanced budgets had moral weight. Governments, like households, should live within their means. Deficit spending seemed irresponsible, a burden on future generations. The argument that deficits during Depression could actually help seemed counterintuitive. Only gradually, painfully, did the idea gain acceptance. Institutions once established develop inertia. The Federal Reserve structure, created in 1913, reflected compromises between centralization and regional autonomy. That structure hampered coordination in the early 1930s. Changing it required legislation, political will, time. By the time meaningful reforms came, much damage had been done. The Depression also revealed how financial crises interact with real economies. The initial shock came from finance, from market crashes and bank failures, but the effects spread through lower investment, lower consumption, lower production. Workers lost jobs, spent less, reducing demand further. The financial and real sectors reinforced each other's decline. Breaking the cycle required addressing both. Financial stabilization alone wasn't enough. Banks needed liquidity, but businesses and consumers needed income. Public works provided jobs, put money in pockets, created demand. Deposit insurance, once established, restored trust, encouraged people to redeposit cash. Together, these measures slowly reversed the contraction. The process took years. From the 1929 crash to meaningful recovery was nearly a decade. For those living through it, the depression seemed endless. Unemployment stayed high, poverty persisted. Only in retrospect does the arc from collapse to recovery seem coherent. At the time, each year brought new uncertainties, new challenges, new policies, some effective, others not. Agriculture, already struggling in the 1920s, suffered especially. Crop prices had fallen after World War I as European production recovered. American farmers, who had expanded during the war, faced oversupply. Land prices fell, debt burdens grew. The Depression accelerated these trends. Foreclosures swept the countryside. The Dust Bowl, environmental catastrophe, compounded economic disaster. The Agricultural Adjustment Act tried to stabilize farm income by reducing supply. Paying farmers not to plant seemed counterintuitive, wasteful. Critics mocked the policy, especially while people went hungry. But from the farmer's perspective, it offered relief. If production could be coordinated downward collectively, prices might rise, incomes recover. The logic was about overcoming a coordination failure in agricultural markets. Urban workers faced different challenges. Industrial production collapsed. Factories laid off workers or shut down entirely. Unemployment concentrated in manufacturing cities, creating pockets of severe distress. Detroit, dependent on automobiles, suffered as car sales plummeted. Steel towns, textile towns, saw similar devastation. Geographic variation meant some regions fared better, others worse, creating uneven hardship. Migration followed opportunity. People left failing regions, moved to cities or to California, seeking work. Labor mobility, usually beneficial, became a sign of desperation. Families uprooted, left communities, homes, identities behind, searching for survival. The migration streams reshaped population patterns, created new communities, strained receiving areas. Through it all, daily life continued. People adapted, made do, found small pleasures. Communities organized, shared resources, supported each other. Oral histories from the era mix hardship with resilience, despair with hope. Human capacity to endure, to find meaning even in difficulty, emerges clearly. Neighbors helped neighbors. Churches organized relief efforts. Local governments, despite tight budgets, tried to provide assistance. Civil society, that network of voluntary associations and informal connections, proved crucial in cushioning the worst effects. Government programs, when they came, supplemented rather than replaced these efforts. The generation that lived through the Depression carried its lessons forward. They valued security, stability, savings. They distrusted speculation, debt, excess. They supported government programs that provided safety nets, having experienced the cost of their absence. They built institutions meant to prevent repetition. Those institutions worked for a time. Financial crises became smaller, briefer. Recessions came, but depressions didn't. Unemployment fluctuated but never reached 1930s levels. Deposit insurance prevented bank runs. Automatic stabilizers cushioned downturns. The Fed responded more actively to emerging problems, but systems evolve. New vulnerabilities emerge. Complacency grows as crises fade from memory. Shadow banking grew outside traditional regulation. Leverage increased through derivatives. Interconnections multiplied across borders and institutions. When stress came in the 2000s, the system proved fragile in new ways, different from the 1930s, but fragile nonetheless. The lessons of the 1930s remained relevant even as the specific mechanisms changed. Trust matters. Liquidity matters. Institutions matter. Timing matters. The Depression taught that inaction during financial crisis amplifies damage. It also taught that financial stability alone doesn't guarantee prosperity. Real economic activity, employment, production, these determine living standards. The tension between financial and real economy persists. Finance should serve the real economy, allocate capital, facilitate exchange. But finance also creates its own dynamics, its own crises. Balancing these requires constant attention, constant adjustment. Rules that work in one era may fail in another. Vigilance can't be permanent. Memory fades. New generations make old mistakes in new forms. What remains constant is the underlying fragility. Financial systems depend on trust, on confidence, on the belief that promises will be kept, that liquidity will be available, that the system will endure. When that belief wavers, when doubt spreads, the system can seize quickly. The speed of modern markets, the complexity of modern instruments, the interconnection of modern institutions may make the next crisis faster, harder to contain. Or perhaps not. Perhaps the tools developed, the institutions built, the lessons learned will prove sufficient. Perhaps central banks can act quickly enough, governments can coordinate effectively enough, markets can adjust smoothly enough. The future remains uncertain, shaped by choices not yet made. History offers guidance, not guarantees. It shows patterns, reveals dynamics, suggests possibilities. But each crisis differs. Context matters. Specifics matter. What worked in the 1930s might not work now. What failed then might succeed today. Judgment, wisdom, courage, these remain essential. Tight money, when trust erodes and banks fail, becomes a slow storm. Credit contracts, spending falls, production declines, unemployment rises. The spiral feeds itself unless interrupted. Interruption requires action, courage, willingness to break with convention. It requires institutions able to respond, leaders willing to act, societies resilient enough to endure. The gold standard constrained response in the 1930s. Countries clung to it, imported deflation from each other, prolonged the pain. Only when they abandoned it could recovery begin. The lesson wasn't that gold was inherently problematic or that fixed exchange rates were always wrong. The lesson was that systems must be flexible enough to adapt to circumstances, that preserving institutional credibility sometimes requires changing the rules. The same principle applies to other institutions, other rules. Balanced budgets make sense in normal times but can be destructive in crisis. Financial deregulation can increase efficiency but also risk. International cooperation benefits all but requires trust and coordination. No single principle works always, everywhere. What works depends on context, on timing, on the nature of the shock. The Depression was a monetary contraction, a credit crunch, a confidence collapse. The solution required monetary expansion, financial stabilization, confidence restoration. Other crises might require different responses. Supply shocks need different medicine than demand shocks. Inflation calls for tightening, deflation for loosening. Understanding the Depression means understanding this context dependence. Policies that seemed prudent, defending gold, maintaining discipline, tightening credit, made sense within a particular framework. But that framework was wrong for the circumstances. Changing the framework required intellectual shift, political courage, Institutional adaptation. These shifts take time. Ideas spread slowly. Institutions resist change. Vested interests defend the status quo. By the time the framework shifted meaningfully in the mid-1930s, enormous damage had accumulated. Millions had lost jobs, homes, savings. Lives had been disrupted, futures altered. Families had been separated, communities had been broken. The pain was real, lasting, generational. Yet the system survived. Democracy endured. Markets recovered. The economy rebuilt. The resilience of American institutions, tested severely, held. This wasn't inevitable, wasn't guaranteed. It required countless individual choices, acts of courage, moments of wisdom, leaders who risked careers to do what seemed right, citizens who maintained faith despite hardship, communities that held together despite pressure. The lessons of the 1930s remain relevant because the underlying dynamics persist. Trust underlies finance. Confidence enables exchange. Credit fuels growth. When these break, when the machinery of finance seizes, the effects ripple through everything. The specific mechanisms change, the institutions evolve, the technologies advance, but the fundamentals remain. Money must circulate, credit must flow, confidence must be maintained. When these fail, when the system breaks, intervention may be necessary, but intervention carries costs, creates risks, sets precedents. The balance is delicate, contested, never final. The Depression taught humility. It showed how quickly prosperity can vanish, how fragile the system is, how important institutions are. It demonstrated the cost of policy mistakes, the value of flexibility, the necessity of learning. It revealed how interconnected the world had become, how problems in one country could spread globally, how coordination could help or hinder. But it also taught hope. Recovery is possible. Systems can rebuild. People endure. The economy that emerged from the Depression was different, more regulated, more stable in some ways, more constrained in others. Whether better overall remains debated, but different certainly. The New Deal's legacy, the Bretton Woods system, the post-war institutions, all reflected attempts to build something new from the ruins, to learn from failure, to prevent repetition. Those institutions served well for decades, then evolved, then faced new challenges. Each generation inherits both successes and failures from the previous one. We inherit the institutions the Depression generation built. We inherit their wisdom and their blind spots. We face our own crises, our own choices, our own opportunities to learn or to repeat mistakes. The slow storm of the 1930s, born from tight money and broken trust, eventually passed. Other storms will come. Whether they become depressions depends on how we respond, what we've learned, what institutions we maintain, what choices we make when tested. The machinery of finance is human-made, fragile, repairable. When it breaks, rebuilding takes time, effort, wisdom, courage. But rebuilding is possible. The Depression proved both the fragility and the resilience. Both lessons matter. Fragility reminds us to be vigilant, to maintain safeguards, to act decisively when crisis comes. Resilience reminds us that recovery is possible, that endurance matters, that human ingenuity and cooperation can overcome enormous obstacles. Between these two truths, between fragility and resilience, between caution and hope, we navigate our economic lives. The 1930s showed the costs of getting it wrong, the difficulty of getting it right, the importance of trying. That lesson echoes still, quiet but persistent, a reminder from history to a present that forgets too easily, that must learn again, that will face its own tests in its own time. Rest now. The story has been told. The patterns revealed, the lessons offered. What remains is sleep, and in the morning, whatever choices the future brings.